Most traders don't fail because of a bad strategy. They fail because their psychology gets in the way. The market has a way of exposing fear, greed, impatience, and overconfidence, and if the mind isn't steady, even the best strategy can fall apart. This video is meant to be more than just something you watch once. Think of it as a trading psychology reset, a video to come back to before a session, after a tough day, or even while trading, whenever focus and discipline are needed most. And for anyone who wants to go a step further, there's a blueprint that brings together proven trading psychology methods with a powerful secret strategy many traders overlook. It may be the missing piece that ties everything together. Stay tuned until the end for more on that, or check the link in the description anytime. Now, let's get started, because by the end of this video, it'll be clear why psychology is the foundation of every winning trade. Trading isn't just numbers and charts. It's a mental battle. Every time a trade is placed, emotions are tested. Will fear take over? Will greed cause overtrading? Or will discipline and patience lead the way? Think about it. A trader could have the perfect strategy, one that works consistently in backtesting. But the moment real money is on the line, emotions can completely change how that strategy is executed. Suddenly, entries are rushed, stops are moved, profits are cut short. The system doesn't fail, the trader does. This is why trading psychology matters. It's the invisible edge that separates professionals from amateurs. It's what keeps traders calm when the market moves against them and confident when the setup is right. Without it, even the best strategy will eventually break down. Studies show that over 90% of traders lose money long-term. And it's not because the markets are unbeatable. It's because most traders can't beat themselves. They chase quick wins. They get greedy after one profitable trade and double their risk. They get fearful after a loss and hesitate on the next setup. This constant emotional roller coaster destroys consistency. Winning in trading doesn't come from predicting the market perfectly. It comes from managing risk, controlling emotions, and executing a proven process with discipline. And that starts in the mind. Let's break down the three emotions that hurt traders the most. Fear. Fear shows up as hesitation, self-doubt, or panic selling. Fear keeps traders from entering good setups or pushes them out of trades too early. It convinces a trader that every candle is a threat and every move against them means disaster. The truth is, fear isn't always bad. It's simply the brain's way of protecting you from perceived danger. The problem is that in trading, fear doesn't protect you, it sabotages you. Greed. Greed makes traders ignore their plan. It whispers, "Hold on, just a little longer," or "Add more to this trade." Greed isn't just about wanting more money, it's about the rush of chasing it. It feeds off wins and tricks traders into believing they're invincible. But the market punishes greed quickly. A single over-leveraged position, a single ignored stop loss, can erase weeks or months of steady gains. Impatience. Impatience leads to forcing trades that aren't there. Instead of waiting for the right setup, traders jump in just to feel active. This is one of the most common traps for new traders because sitting on the sidelines feels unproductive. But in reality, trading is often 90% waiting and 10% acting. The best setups require time. Now here's the key: awareness. The moment a trader learns to recognize these emotions in real time, they begin to regain control. Awareness leads to discipline, and discipline leads to consistency. But awareness alone isn't enough. There need to be tools, ways to redirect emotions in the moment. Let's go through some practical exercises. Exercise 1, the fear reset, a 2-minute breathing drill. Whenever fear takes over, whether it's fear of pulling the trigger or fear of losing, pause for 2 minutes. Close your eyes if you can and focus on slow breathing. Inhale deeply for 4 seconds, hold for 4 seconds, Exhale slowly for 6 seconds. Repeat. Do this 5 to 6 times. What this does is calm the nervous system and quiet the part of the brain that overreacts. The fear doesn't vanish, but it stops controlling the decision. Many professional traders use breathing drills like this before entering big trades. Exercise 2, the greed check, a verbal confirmation. When greed shows up, the urge is to hold too long or risk too much. The solution is to speak the plan out loud. Say to yourself, my target is here, my stop is here, my risk is set. Once this plan is in place, I do not change it. Verbalizing the rules turn them from thoughts into commitments. It's harder to break your rules when you've said them out loud. Exercise 3, the impatience break. Step away from the charts. Set a timer for 10 minutes. Walk away from the charts. Do something else. Stretch, drink water, step outside. Most of the time, by the time you return, the urge to force a trade is gone. And if the setup really is valid, it will still be there. Exercise 4, journaling emotions in real time. This one may feel unusual, but it's powerful. Keep a notepad or digital journal open while trading. Every time you feel an emotion, fear, greed, or impatience, write it down. Examples. I feel nervous about entering even though my setup is valid. I want to add more to this trade even though I'm already at risk limit. I feel like entering just to be in the market, but there's no setup. By writing emotions down, you create distance. Instead of acting on them, you're observing them. Over time, this practice rewires how you respond. Exercise 5, visualization before the session. Before trading, spend a minute visualizing common scenarios. The trade that instantly goes against you, the winning trade that tempts you to hold longer, the market that moves sideways for hours. Then imagine yourself responding calmly, following the plan, sticking to risk, staying patient. The brain can't fully tell the difference between visualization and reality, so practicing responses in your mind makes it easier to execute them in real time. Here's the truth. Fear, greed, and impatience will always exist. They're wired into human nature. The goal isn't to eliminate them. It's to recognize them, manage them, and never let them control decisions. The trader who builds awareness and uses simple tools like breathing, verbal confirmations, breaks, journaling, and visualization will always have an advantage over those who let emotions run wild. Consistency doesn't come from fighting emotions. It comes from mastering them. The trader who learns to do that will not only last in the markets, but thrive in them. Discipline is the backbone of trading. Without it, even the best strategy falls apart. Think of discipline as a muscle. It doesn't just appear overnight. It's built through repetition, consistency, and constant practice. And just like a muscle, the more it's used, the stronger it becomes. In trading, discipline is not just about following a plan when it's convenient. It's about following the plan when every emotion in your body is screaming to do the opposite. Why discipline matters. A trader without discipline is like a pilot flying without instruments. The plane may stay in the air for a while, but sooner or later a storm will come. Without the discipline to trust the instruments, the pilot will panic and crash. The same is true in trading. Without discipline, a trader may win for a short time, but eventually the market will test them. If they abandon the plan, they'll spiral into losses. Discipline protects traders from themselves. It creates consistency in an environment that thrives on chaos. The foundations of trading discipline. Have a written plan. Every trade should be guided by a plan. Entry, stop loss, and target. Without it, emotions will take control. Writing down the plan before a trade builds accountability. Risk management rules. Never risk more than a small percentage of capital on any trade. For many professional traders, that's 1 to 2%. This simple rule turns large losses into manageable setbacks. Accepting losses. Losses are part of trading. No strategy wins 100% of the time. The disciplined trader accepts losses calmly and moves on, knowing that one trade doesn't define their career. Routine and consistency. Discipline grows stronger when tied to routine. Doing the same preparation, the same journaling, and the same risk management every day creates stability. Common discipline killers. Even the most experienced traders struggle with discipline killers. Revenge trading after a loss, over-trading when bored or impatient, moving stops because the market will turn back, breaking risk limits after a winning streak. These actions feel good in the moment but destroy consistency over time. Practical discipline exercises. Now, let's go through some practical tools to strengthen discipline. Exercise 1. The one trade rule. Pick one setup, commit to trading only that setup for a week. Every time the urge comes to trade something else, write it down, but don't act on it. This trains the mind to resist temptation and stick to process. Exercise 2. The 3-strike rule. Give yourself a daily loss limit. For example, if 3 trades in a row lose, stop trading for the day. This prevents emotional spirals and forces discipline through boundaries. Exercise 3. Delayed gratification practice. Outside of trading, practice small acts of discipline. For example, wait 10 minutes before checking your phone in the morning, or delay eating dessert by 5 minutes. These small habits spill over into trading, strengthening patience and control. Exercise 4. Pre-trade checklist. Before entering any trade, go through a checklist. Did I mark my entry, stop, and target? Is this setup part of my plan? Am I risking the right amount? Am I trading because of the setup or because of emotion? Checklists create structure. They turn discipline into a system, not just willpower. Exercise 5. Journaling for accountability. At the end of each trading day, write one simple question. Did I follow my plan today? Not whether you won or lost, just whether you followed the plan. Over time, this builds self-honesty and strengthens the discipline muscle. Discipline and action. Picture 2 traders. Both have the same strategy. The first trader breaks rules when emotions run high. He moves stops, increases risk, and chases trades. His results are inconsistent. The second trader follows rules no matter what. Some days are boring, some days are tough, but over weeks and months, the results are steady. Who survives long term? Always the second trader. Discipline, not excitement, is what pays in the markets. The reward of discipline. Here's the truth. Discipline doesn't always give instant results. Sometimes following the plan still means taking a loss, but over time, discipline compounds. Think of discipline like compound interest. Each small act of following the plan adds up. Each avoided emotional mistake protects capital. Over weeks, months, and years, the difference becomes enormous. This is why the best traders are often the most boring traders. They're not chasing the thrill. They're showing up, following the process, and letting the discipline pay off. Final note on discipline. Remember, discipline isn't about being perfect. Everyone slips, everyone makes mistakes. What matters is the ability to reset, refocus, and come back stronger. The market rewards discipline and punishes impulsivity. The more a trader commits to structure, the more freedom they actually gain, because they're no longer controlled by emotions. And in the end, discipline is what turns a strategy into a business, and a trader into a professional. Routines are one of the most overlooked advantages a trader can have. The markets are unpredictable, chaotic, and emotional. Routines create structure, a reliable anchor in an unpredictable environment. Think of routines as the framework that keeps your mind sharp and your trading consistent. Elite athletes, surgeons, and pilots all rely on routines. A football quarterback has pre-game warm-ups. A surgeon has pre-op checks. A pilot goes through a pre-flight checklist. These routines aren't optional, they're essential. Why? Because routines reduce errors, keep stress low, and train the brain to perform automatically under pressure. Trading is no different. The trader who develops a strong routine has a mental advantage over one who improvises every session. Routines reduce the mental load, leaving room for focus, observation, and strategic thinking. Morning or pre-market routine. A strong trading day starts before the first trade. Here's what a pre-market routine might look like. Higher time frame review. Start by looking at the daily, weekly, and monthly charts. Identify major support and resistance zones, trend direction, and volatility levels. This sets the context for every trade and reduces the risk of reacting impulsively to small fluctuations. Plan your trades. Based on your analysis, select setups you're willing to trade. Define entries, stops, and targets in advance. Writing them down reinforces commitment and reduces second-guessing. Mental check-in. Ask yourself, am I focused? Am I calm? Am I in the right mindset? Emotional readiness is just as important as technical readiness. If your mind is distracted, fatigued, or stressed, it's better to step away than to risk trading emotionally. Visualization. Spend a minute visualizing common scenarios, the market going against you, the market hitting your target, or periods of sideways action. Picture yourself responding calmly, sticking to your plan, and managing risk properly. This prepares the mind for reality and reinforces confidence. Affirmations. Create a simple mantra for the day. For example, I follow my plan. I manage my risk. I remain disciplined. Say it out loud. Mantras condition the mind and set a tone of control for the session. During the trading day. Routines don't end when the first trade is placed. What you do while trading is just as important. Scheduled breaks. Take short breaks between trades. Step away from the screen, stretch, or hydrate. These breaks prevent fatigue and emotional drift. Check emotional state. Throughout the day, pause and ask, am I trading because of opportunity or because of emotion? This simple habit keeps impulsive trades in check. Review trades in real time. After each trade, quickly note how you felt and whether you followed the plan. This reinforces accountability and accelerates learning. End of day or post-market routine. The day doesn't end when the market closes. Post-market routines are essential for growth. Journal review. Review all trades, not just for profit and loss, but for discipline and emotional control. Ask yourself, did I stick to my rules? Did I act on emotion at any point? Reflect and learn. Identify patterns, both good and bad. Are there recurring mistakes? Are there behaviors that consistently lead to success? Awareness turns experience into skill. Prepare for tomorrow. Sketch preliminary setups or mark key levels for the next session. This reduces stress in the morning and primes your brain for preparation. Practical routine exercises. Here are exercises to strengthen routines. Exercise 1. The 1-hour pre-market routine. Commit to one focused hour before trading to review charts, set plans, and do mental preparation. No trading distractions allowed. Over time, this builds consistency and confidence. Exercise 2. The trade pause drill. After every trade, pause for 60 seconds to reflect before taking another. This reinforces patience and prevents emotional chaining of trades. Exercise 3. End of day reflection sheet. Keep a single-page journal with these columns. Trade number, emotion, did I follow plan, lesson learned. This visual log builds self-awareness quickly. Exercise 4. Weekly routine review. Once a week, review your routines. Are they still effective? Are you skipping steps? Adjust as needed. Routines should evolve with your trading skill and goals. Why routines multiply discipline and psychology. Routines act like scaffolding for trading psychology. Even on emotionally difficult days, a strong routine keeps you grounded. It automates discipline and reduces decision fatigue. The more consistently a trader follows routines, the less mental energy is wasted on fear, greed, or impatience. Think of routines as the GPS for trading. The market is unpredictable, but a GPS keeps you on course. Discipline is the engine, psychology is the steering wheel, And routine is the map that ties it all together. By building strong routines, traders create an environment where consistency becomes inevitable. Consistency, as we've discussed, is the bridge to long-term success. Trading can be mentally exhausting. Losing streaks, missed opportunities, and market volatility all test your focus. That's why resetting a mind is one of the most powerful tools a trader can use. A reset isn't a single technique. It's a combination of reflection, visualization, and mental rehearsal. Step 1. Mental pause. Take a moment to close your eyes and breathe deeply. Inhale for 4 seconds, hold for 4, exhale for 6. Do this 3 to 5 times. This simple act slows the nervous system, reduces stress, and allows the mind to reset. Step 2. Reflect without judgment. Look back on your recent trades, but don't attach labels like good or bad. Instead, ask, did I follow my plan? Did I act on emotion or logic? What can I do differently next time? This neutral approach removes the emotional weight of mistakes and allows you to learn efficiently. Step 3. Visualization reset. Imagine the ideal trading session. You see a high probability setup. You enter calmly, following your plan. You manage risk correctly. You exit the trade with confidence, regardless of profit or loss. By rehearsing success in the mind, the brain builds muscle memory. The next time you face a similar scenario, your response is faster and more disciplined. Step 4. Affirmations. Positive affirmations reinforce control and mindset. Examples: I follow my plan consistently. Emotions do not control my trading. Every trade is an opportunity to practice discipline. Say these slowly and deliberately. Make them personal. Over time, they become automatic thought patterns. Step 5. Micro reset during trading. Even in the middle of a session, a 30 to 60-second pause can help. Step away from the screen, close your eyes, and repeat your affirmations, or take 3 deep breaths. These micro resets prevent emotional spirals and help you stay calm when trades don't go your way. All of these skills, awareness of fear, greed, and impatience, discipline, routines, and reset techniques, combine to create a professional trading mindset. Trading psychology is not a one-time lesson. It's a skill that must be practiced every day. Like physical fitness, you don't build strength in a single workout. You build it through repetition, focus, and incremental improvement. The market is unpredictable, but with strong psychology, a trader has a constant advantage: the ability to respond calmly, execute a plan, and manage risk effectively. Remember, strategies don't fail. Traders do, when they let emotions take control. Your mind is the most important tool in trading. Master it, and the market becomes manageable. For those ready to take this further, there's a blueprint that combines these psychology techniques with a secret trading strategy that many traders miss. It's designed to tie mindset and method together, giving you an edge beyond charts and indicators. This isn't a gimmick or a shortcut. It's a structured system that complements everything we've discussed: awareness, discipline, routines, and resets. The link is in the description, or you can stay tuned after this video to learn more. Think of it as the final piece of the puzzle, the part that allows your psychology and strategy to work together seamlessly. Trading is a journey, not a sprint. There will be wins, losses, frustrations, and breakthroughs. The key is to remain consistent, disciplined, and emotionally intelligent. Every time you feel doubt, fear, or impatience, remember the exercises in this video. Pause and breathe. Reflect on your mindset. Visualize ideal trades. Follow routines and checklists. Journal your emotions. Consistency, not excitement, is the key to long-term success. Discipline, not luck, builds careers. Awareness, not prediction, wins trades. Come back to this video whenever needed, before, during, or after a trading session. Let it reset your mind, reinforce your routines, and remind you of the power of psychology in trading. Finally, for those ready to combine all these lessons with a powerful secret strategy, check out the Trading Psychology and Secret Strategy Blueprint in the description. It may be the missing piece that elevates your trading to the next level. Stay disciplined, stay patient, stay focused. Master the mind, and the market follows.